Hello. So welcome to our next chapter, last chapter of our audit that we are doing now. That is your due diligence investigation and forensic audit. Now this is a comparatively big chapter as this is covered in about 7 pages in our notes, in our audited 100 pages notes. Now this comes for approximately 5 to 6 marks in every attempt. This is your average 5 to 6 marks in every attempt. The last three attempts, it has come for a total of 18 marks. So it is a very important chapter. And there are also some amendments in this where wherever forensic auditing was used, now it is forensic accounting. Wherever forensic auditor was used, now it is forensic accountant. Okay, so starting with the chapter. So this chapter is divided into basically three parts. First is your due diligence, second is your investigation, and third is your forensic accounting. So let's start with the first part, that is due diligence. So you'll ask me, sir, what is due diligence? Due diligence is the process of investigation performed by investors into the details of potential investments, such as an examination of operations and management and the verification of material facts. So, your due diligence is done by an investor. So, either before he invests into a business or before he purchases a business, he will do his due diligence. He will do his checks, he will do his valuation, whatever is required. So, it is done by investors into details of your potential investment. Okay. Now, reasons to carry out due diligence. Why is due diligence carried out? First is to confirm that the business is what it appears to be. That means what it is shown in balance sheet, that is what the business is actually. Next, to identify potential deal killers defects in the target company. If there are some deal killers, for example, when Elon Musk was buying Twitter, he found that a lot of majority of the accounts are bot accounts. That means they are not real accounts. So now that was a deal killer. But since he had already entered into the deal before doing his due diligence, therefore he had to buy Twitter. Next, to gain information that will be useful for valuing assets. So when they will decide the valuation of assets, that time this information will be valuable. Next, to verify that the transaction complies with the investment criteria. That means whatever investments you want, whatever criteria you have set, whether the transaction complies with that or not. Now, what are the classification or areas of due diligence? That means how, on what are the different areas of due diligence where all due diligence is done. So first is your commercial or operations due diligence. Next is your information system, your financial due diligence, personal due diligence, that means your people. Next is your environmental due diligence, tax due diligence, and your legal due diligence. Okay. Then what is financial due diligence? So as we studied over here, your financial due diligence, what is financial due diligence? Role of financial due diligence commences only after a price has been agreed for the business. So only once the price has already been agreed will then the financial due diligence start. The principal objective, therefore, is usually to look behind the veil of the initial information provided by the company. That means whatever the information the company has provided, you have to look past through it and assess the benefits and cost of the proposed acquisition by inquiring into all relevant aspects of the past, present, and future of the business. Since you are now investing into the business or you're acquiring the business, you need to know everything about the business, your past, present, and your future. The due diligence process can include any or all of the following objectives. Basically, what are the objectives of your due diligence? First is brief description of the history of business. Then background and standing of promoters. Next is management information system, and last is details of management structure. Okay, so these are your four. Then there are another four, that is your accounting policies followed, cash flow patterns, projection of future profitability, and assets and liability as per your balance sheet. So, okay, so what are your objective? What are your objective? First is your history of business. You have to understand brief description of the history of business. Okay, history of business is done. Now, what will you do? You will understand the promoters. That is background and standing of the promoters. Okay, so now promoters are done. Your business is done. Now, what management related it will be there? So therefore, next point is your management information systems, and your next point is also related to management. So one is management information system, and next is details of management structure. Okay, so first was your business, then second was your promoter, third is management, fourth is management. What is fifth? Fifth is your accounting policies followed. Next is your cash flow patterns, then projection of future profitability, and last is your assets and liabilities as per balance sheet. So if you see assets and liabilities, this is as per your balance sheet. Profitability you get to know in your P&L. Your cash flow patterns you get to know in your cash flow statement. And next is your accounting policies followed. Okay, so basically all these are all your books of account that you maintain, your balance sheet, your P&L, your cash flow statement. So all of these objectives are related to this. Okay, next is hidden liabilities. So how to check hidden liabilities, or what are examples of hidden liabilities? So any show cause notice is not matured into deposit. That means if any department, if any tax department has given you a show cause notice as to why we should not charge you, why we should not penalize you. So it is still a show cause notice. It has not matured into a demand. That means it has not converted into a demand yet. Therefore, it is a hidden liability. That means this liability will arise in the future, may arise in the future. Next is your letter of comfort given to banks and your financial institution. Liabilities of subsidiaries sold. That means if any subsidiaries have been sold and you have agreed for certain liability that may arise later, so these liabilities are your hidden liabilities. Next is warranty liabilities, product and your liability claim. That means whenever you sell goods, whatever goods you sell, you also sell some warranty. That means if the goods are defective, you, within the time period, I will replace the goods or I will refund you. So now this is also your hidden liability. Next is your tax liabilities under direct and indirect tax. Then you have your sales tax assessments, unresolved labor litigations, and last is your agreement to buy back shares sold. That means if you have ever entered into an agreement to buy back the shares, now whenever is the maturity period, that time it will be a liability. Therefore, it is a hidden liability right now. Okay, so these were your examples of your hidden liability. So show cause notice, letter of comfort, then subsidiary sold liability, then you had various tax departments, then show cause sales tax assessments, unresolved labor litigations, and agreement to buy back shares sold. Now, what are your examples of your overvalued assets? So your overvalued assets are uncollectible receivables. Uncollectible receivables mean they are showing as debtors, but you will never be able to receive them. Therefore, these assets are overvalued because you're not about to receive any money from those. Next is obsolete or slow moving inventory. Obsolete means very old inventory, which there is no reliable value. Next is your obsolete plant and machinery. Then you have litigated assets and property. That means assets which are under uh, and in the court, some cases going on. Next is assets whose carrying value is greater than the market value. That means the value that we are showing in the books, that is much higher than what is the actual market value. In such a case, it is an overvalued asset. Intangible assets with no value. You have an intangible asset, you've shown at a value, but there is no actual real value to it. Investments with your low ROI, and last is investments carried at cost though NRV is lower. So investments carried at cost even though NRV is lower. So basically there are two assets whose carrying value is less than whose carrying value is more than market value, and investments carried at cost even though NRV is lower. So these are your examples of overvalued assets. Next is scope of full-fledged financial due diligence. Basically, what is the scope? So in scope, it is the history of the target company and background of its promoters. If you see, while doing while doing the objectives, we did history and background of promoters. So over here, both of these points are put into one. Then over here, if you remember, we also did your accounting policies being followed. We did this point, accounting policies being followed. So see, this becomes your second point, that is your accounting policy. This is I'm trying to show you how can you remember points. So while studying the scope, first is your history. History of the target company. History of the target company means the company that you are purchasing, and the background of its promoter. That means the company that you are going to purchase or you are going to invest in, the background of their promoters. Next is accounting policies. Then is review of financial statements. Review of financial statements. What you have to remember? You have to remember this side you will still be able to write, the right side you will still be able to write, but left side you have to remember point by point. So first is your history of the target company and background of its promoters. Then second was your accounting policy. Third is your review of financial statements. Fourth is taxation. Fifth is cash flow. Sixth is financial projection. Then you have management and employees and your statutory compliance. Okay, so pause the video, remember it right now. Read these points, just read these points that is written in black and then move forward. Okay, so first was your history of the target company and the background of its promoter. This is one point. Next, if you remember, was your accounting policies. Okay, now the third that you did was your review of financial statements. Then we did taxation. Then we did cash flows. Then we did your financial projection, management and employees, and statutory compliance. So let's quickly read. Let's quickly read what is written inside this. Okay, so nature of business, location of production facility, employee products, inventories, R&D, etc. In accounting policies, check effect of any recent changes in policy. If because of the sale of business, if any recent changes in policies have been done to inflate the value of business, might have changed accounting policy in past, keeping in view intention to sell, so that the business is valued at higher. Compare the actual figures, review of financial statements, compare the actual figures with budgeted figures. Normal operating profit should be benchmarked against similar companies. You have to check whether similar companies, whether its competitors are obtaining somewhat similar profits or not. Taxation is your tax effects of the merger or your acquisition. Under cash flow, cash generating ability of the target company, check that the company, so there are basically 5 checks, whether it is able to honor commitments. Honor commitments mean whether it is able to meet commitments, any liabilities to the TP bank or your government. Next, how well it is able to convert trade receivables and inventory. That means how properly it is able to convert your inventory and your debtors into cash. Next, how well does it deploy funds? Any funds are lying idle. And last is, what is the investment pattern of the company and whether it is easily realizable. That means your investments, whether they can easily be converted into cash or not. Then your financial projection, obtain projection for the next 5 years with assumptions and working. Projection shall be based on 3 scenarios, that is your optimistic, pessimistic, and most likely case. So optimistic is your best case, pessimistic is your worst case, and then there is a most likely case, that means most likely what will happen. Management and employees, how much of the labor force has to be retained? Also check what is your ESOP commitment, because these ESOPs are already been issued. You have to give them the shares after the vesting period. Next is list of laws applicable and checklist of compliance. You have to check whether all laws and regulations have been complied or not. So this we were doing was your scope of your financial due diligence. Scope of your financial due diligence. First was your history. Then second was your uh, accounting policies. Then was your review of financial statement. Then it was taxation. Then after taxation, it was cash flow statement. Then there is sorry, just cash flow. Then there is your financial projection. That means of 5 years in 3 different scenarios. Then we did your management and employee. That means how many people have to be retained and your point related to ESOP. And last was your statutory compliance. That is with regards to laws and regulations being complied or not. Next is work approach. Work approach to due diligence. So first of all, review and reporting on the financial. First is review and reporting on the financial. Second is assess the business by a site visit. That means by a physical site visit, you will check how well the business has been operating. Working through the due diligence process by defining key areas. You have to check what are your key areas where you have to put more focus on, and helping prepare an offer based on completion of your due diligence. So this is your work approach. So first you will review the financial, second is assess the business, third is working through the due diligence by defining key areas, and fourth is your preparing an offer. Next is how to conduct due diligence. How to conduct due diligence is, first is your pre-due diligence period, second is your due diligence process and negotiation, and third is your closing. So in pre-due diligence, of course, you will discuss with the client, centralize and coordination of team. That means your due diligence team, you have to identify that which all people will be working with me on this project, and prepare a DD request list. That is, you also have to prepare what all data you require to do this. Next is due diligence process and your negotiation phase. So working on or offsite, that means either physically on the site or you are working remote. Next is your question and answer process with the management, and third is your report drafting. So in the report drafting only you will do this in the negotiation phase itself. That is your phase 2. Now in your phase 3, what do you do? That is closing and post closing process. Prepare and review your closing documents. Involvement in price adjustment procedures using due diligence findings, because you will also have to give adjustments based on what due diligence findings you get. If you get any overvaluation of assets or any hidden liabilities in such a case, of course your valuation will be affected. Now, what points do you have to remember while doing this? You should start with an open mind. Do not assume anything wrong and look for it. So you have to start with the open mind as if everything is fine. Next, get the best team of people. Can hire experts if experts are not available within the team. Get help in all areas like finance, tax, legal, marketing, technology, etc. etc. Talk to customers, suppliers, business partners, and employees, as these are great resources for information. And last is prepare a comprehensive report detailing the compliances and your substantive risk. So detailing your compliance and substantive risk. Now, next is what are contents of due diligence report. So in this chapter, all of the things in your blue boxes was your due diligence. Now everything in green will be your investigation. So what are the contents of the report? So your summary, introduction, background, objectives, terms of reference, brief, history, shareholding pattern, all of these are your contents. Observation of the review, assessment of what? Assessment of management structure, financial liabilities, valuation of assets, operating results, taxation, net worth. So all of these are your assets. These are all your contents of your due diligence report. Okay, with this we are done with due diligence, and now we are starting with your investigation. Now, investigation. What is investigation? Investigation is a systematic and in-depth examination. Systematic and in-depth examination, because when you say you are being audited versus when you are saying you are being investigated is a more deeper, more focused approach. So a systematic and in-depth examination of inquiry to establish a fact or to evaluate a specific situation. So these are particularly done for any reason. So difference between investigation and audit on basis of objective. It aims to establish a fact, while your audit main aim is to check whether financial statement display a true and fair view. Next is your scope. May or may not be governed by any statute. That means may or may not be governed by any law. However, your audit is determined by your provision of law. Next is periodicity. There is no rigid time frame, but however, for audit, it is either quarterly, yearly, or half yearly. Next is your nature. It is a detailed study and examination of facts. However, audit is test checking and samples, because in investigation it is detailed study. As I told you, in audit you are allowed to take samples because you cannot check the entire population. Next is your inherent risk. So there are no inherent limitations, but your audit suffers from inherent limitations since you do not check the entire population. Next is your evidence. Seeks conclusive evidence. So your investigation needs proper evidence, conclusive evidence. However, your audit will get prima facie evidence, because the auditor is a watchdog and not a bloodhound. Next is your reporting. So person on whom behalf it was carried out. That means your investigation report will be given to whom? It will be given to the person on whose behalf it was carried out. However, in case of audit, it is for the owners of the business entity. Okay, so this is your point with differentiation between investigation and audit. Now, what are the steps in investigation? There are 5 steps in investigation. First is your determination of objectives and establishment of scope of investigation. So first is your objective and scope you have to determine. Now what is your second? Second is your formulation of your investment program. So first we did your objective and scope. Second is your formulation of program. Third is collection of evidence. Fourth is analysis and interpretation of findings. And fifth is reporting of findings. So first what did you do? You decided what will be your objective, what will be your scope. Then second, what did you do? You made a program. You made an investigation program. Now third is you will collect the evidence. You will collect the evidence while doing the work. Fourth is you will analyze and interpret the findings. Whatever findings you get, it is not enough. You also have to analyze those findings. And fifth, your last point is reporting of findings. Okay. So first is objective and scope. Second is your program. Third is your evidence. Fourth is your analyzing findings. And fifth is your reporting of findings. These are your steps in investigation. Issues to be kept in mind while preparing reports. So the report should not contain anything that is not relevant with respect to nature of investigation or final outcome. So report should contain only that information which is necessary for the investigation purpose. Every word should be used carefully so that the possibility of arriving at different meanings is minimized. That means please carefully use your words, because sometimes same word might have multiple meanings. Relevant facts and conclusions to be linked with evidence. That means whatever conclusions you get, that should be linked with evidence. You have to show as to how you got this evidence. Bases and assumptions made should be explicitly stated. Any assumption that you made, that should be properly stated, clearly stated. Report should clearly spell out the nature and objective of the assignment accepted, its scope and your limitations. Next, the report should be made in paragraph form with headings for the paragraphs. Report should also state restrictions or limitations if imposed on the instructions given by the client. So if there are any restrictions given that boss, you need not check this area, you have to specifically say that in the report. And last is opinion of the investigator should appear in the final paragraph of the report. So opinion should appear in the final paragraph. Next is special issues in investigation. So whether investigator has to undertake 100%, that means 100% of verification, or he can adopt selective verification. That means he will select some parts and only he will check those. Whether the investigator can put reliance on already audited statement of account. Are those audited statement of account trustworthy or not? Next is whether an investigator necessarily requires the assistance of expert. Is it necessary that he requires help of any expert, or is his team enough? Investigation out of disputes and conflicting claims. Basis of opinion of an investor. Whether an investigator can make futuristic statement, that means anything related to the future. And last is whether to retain working papers or not. That means whether working papers can be retained or not, working papers of the investigator. Okay, now special aspects in connection with business investigation. So in business investigation, when you are doing the audit of business, you have to check some special aspects. Now I will not be going into depth because these are all points which are clearly, for example, when you're checking the balance sheet, what will you be checking? Fixed assets, inventory, investment, trade receivable, other liquid assets, idle assets. These were all your assets. Then you have your liabilities, taxation, capital. These are all your liabilities part. So therefore, what you have to remember is your left part. So first is studying the overall picture. So special aspects in connection with the business investigation. So when you are investigating a business, what are the special aspects? That means what are the important areas that you have to focus on? First is your studying the overall picture. Okay. Next is your statement of your P&L. Now, of course, if you are doing P&L, you also have to do your balance sheet. Then after balance sheet is your interpretation of figures. That means whatever number you have, how do you interpret these figures? Okay. Hmm. So these are your four special aspects in connection to business investigation. I will pause the video. I will pause the video here 1 second so that you can read if you want to read what is written inside them, and then we will move forward. Okay. I hope everybody has paused. Now we are coming to types of investigation. Now your types of investigation are basically two types of investigation. One is your statutory and second is your non-statutory. Now under statutory, your two types of investigations are into the affairs of the company and second is ownership of company. So if you are investigating into the affairs of the company, now this will be possible because of three cases. So if it is done by the inspector through order of your central government, as per section 210. If you remember all of these sections you have done in your law, that is your SFIO, your serious fraud investigation officer, etc., etc. So all of these sections 210, 12 and 13 are all from that chapter. Okay. Next is by your serious fraud investigation office, that is your 212, and next is in any other cases provided under section 213. So in such a case, your investigation will be done into the affairs of the company, and this will be your statutory investigation. That means it is required by law. Steps of investigation is first is clarity of terms of reference. Second is your scope of investigation. Now remember, whenever you are writing your steps of investigation, any steps, any processes, you are not allowed to mix the point. You have to write them as it is one after the other. So clarity first is your clarity of terms of reference. Second is your scope of investigation. Third is your period of investigation. Fourth is framing of program. Fifth is using work of expert, and last is your legal requirements and your investigation report. Now, next is your ownership of company. Ownership of company is governed by section 216. So we did 210, 212, 213 and 216. These are your statutory investigations. So scope and extent of investigation specified in order of investigation issued by authority. So what will you do? You will check the dealing with subsidiaries, directors. It is possible that any profits may have been transferred to these people. Factors responsible for losses to be investigated as to why the company is making losses, and last is negligence in discharge of duty by a director. Okay, so all of this you have to check in your statutory audit. In your statutory audit, that is your ownership of your company, that is as per section 216. Okay. Next are your non-statutory investigations. So there are certain non-statutory investigations. First is your on behalf of an incoming partner. So when a partner is entering into partnership firm, what all things do you think we should check? Of course, first is your history and inception of the growth of the firm. Next is your, of course, your partnership deed, your capital contribution, goodwill, retirement benefits, etc., etc. Your partnership deed, of course, has to be checked. Next is your profitability of the business, examination of your assets and liabilities, position of orders at hand. Position of orders at hand means you have already received the order, you still have to give them, you still have to deliver. Position and terms of your loan finance, that means whatever loan you have taken, what are the terms of the loan. Composition and quality of your key personnel, and last is manner of computation of goodwill. So before there is a new partner coming into before a new partner comes into the partnership firm, certain things will be checked. Of course, your history will be checked. Then second, your partnership deed will be checked. Your profit over the years will be checked. Your cash, your orders at hand will be checked. Then your uh, what are the other points? Of course, your position and terms of your loan finance, examination of assets and liabilities. We already did this. Then composition of your quality of key personal, and last is manner of computation of goodwill. So all of these points will have to be checked. Next is your second point. Second investigation, non-statutory investigation is your valuation of shares in private company. Valuation of shares in private company. So basically there are two methods. First method and second method. Now your first method is on net worth basis. That means assets to be valued. So what are you doing? You are doing valuation of shares. So assets to be valued, taking into account the utility to business. Value of goodwill is the capacity to earn super profits. Of course, value of goodwill is whatever profit you are earning minus normal profit. That means what everyone else is earning. That is your goodwill, and period over which these are expected. So this is your value of goodwill. Okay, next is your method two, that is your yield basis. So value of share is the present value of all future dividends. Of course, if you are valuing a share, how will you value a share? You will discount the dividends that you receive. Therefore, your method two is your yield basis, that means present value of all future dividends. Rate at which amount of dividend is to be capitalized will depend on the risk, business background, etc. That means with which rate we will be discounting it. That will depend upon the risk of business. Next is if it is on behalf of a bank to advance loan, that means a bank is going to advance a loan to a business, but before it advances this loan, it wants to do an investigation into the company. That means where I'm putting my money, will it be safe or not? Will I get this money back or not? So what do you have to check? Purpose for which the loan is required, schedule of repayment, that means when the borrower will repay how much, etc., etc. Next is your financial standing and reputation of the business, whether allowed to borrow money as per your memorandum of articles and your as per your MOA and your AOA, whether it is allowed or not. History of growth and development in the last 5 years, and last is reasons for rejection of loan application to another bank. That means if they had already applied to another bank and the other bank had already rejected their application, you have to check as to why this other bank has rejected the application. To investigate profitability of business, to judge accuracy of schedule of repayment. So now what did we do? We did this point. Just a second, I'll erase this. We did your schedule of repayment. So now to check that the schedule of repayment that he has given, to check that accuracy, you will prepare a condensed means together. You will prepare a condensed statement of P&L for previous 5 years. Okay. And you will show separately the income, expenditure, gross profit, net profit, and tax. All of this you will separately show. Next is your compute ratios and show changes sales to average inventory, sales to fixed assets, equity to fixed assets, and current assets to current liabilities. So you will calculate all of these ratios and you will check how much it has changed over the years. And last is your breakup of sales product wise. Okay, so to check whether the schedule of repayment is accurate or not, these are what checks you will do. Next is verification of assets and liabilities in balance sheet of borrower company submitted to bank. So you're verifying your assets and liabilities in the balance sheet, verifying assets and liabilities in the balance sheet of the borrower company. That means the company to whom the loan has been advanced, submitted to the bank. So of course, these are your things that you will check: fixed assets, inventory, trade receivables, investments, secured, unsecured loan, provision for tax, other liabilities, insurance, contingent liabilities. Of course, all of these areas you will check. I'm not going into much depth because if you want, you can pause the video and you can read it. Next is on behalf of a buyer buying a business. On behalf of a buyer buying a business, your business, if the business is a proprietary or a partnership firm, that means if it is not a company. So if it is either a proprietorship firm or a partnership, in such a case, you will check what is the reason for sale, what is the length of the lease of the premises. That means where the office is actually, what is the length of the lease. Next is your unexpired period of patents. Unexpired period of patents, age of managerial staff, because you have to pay them gratuity. Next is valuation of goodwill, and last is your customer order value. That means every customer orders for average of what amount. Then if the business is a limited company, so if you're doing on behalf of buying a business and the business is a limited company, authorized and issued capital, whether there is any uncalled liability on shares. Uncalled liability on shares means you have to pay this amount on any other place where you have invested. Rights attached to each class of share, because there are different classes of share. There is your uh, special equity share, there is your preference share, some have voting rights, some have differential voting rights, etc., etc. Particulars of dividends paid in the past, changes on assets of the companies, and last is price at which the shares are being offered. So if your business is a limited company, all of these checks you have to do. Now, in the same part, now we are doing investigation, non-statutory investigation of frauds. So fraudulent financial reporting and misappropriation of assets. So these are basically your two types of frauds. That is, first is your fraudulent financial reporting, and second is your misappropriation of asset. So fraudulent financial reporting, there is fictitious journal entries, abnormal year-end transaction. That means at the year end, just to make the fraud clean, just to clean the book, there will be some abnormal transactions. Intentional misapplication of accounting principle. That means the accounting principle, you are purposely applying it in a way in which it is not intended. Intentional omission of transaction. That means you skip some transactions purposely. And last is adjusting assumptions. So any assumptions which will just adjust the differences. These are your fraudulent financial reporting. Fraudulent financial reporting. Fraudulent financial reporting. Okay, so that is your fictitious journal entries, abnormal year end. Then there are two intentional, and last is your adjusting assumption. Now, misappropriation of assets. There is payment to fictitious employees, stealing of physical assets, introduction. So if you check all of these were related to your books of accounts, and all of these are actually related to your assets, either cash or your inventory, etc. Introduction of fictitious vendors, using entities' assets for your personal use, and last is embezzlement of receipts with respect to, just a second. Okay, embezzlement of receipts without with respect to written off accounts. Okay, WO is written off. So if you're embezzling any receipts out of written off accounts. Okay, now what are your different types of frauds? You have your fraudulent entries, you have collection frauds, then you have expense frauds. Just a second, yeah, now so that it is visible to you. Expense frauds, payroll frauds, data frauds, technology frauds, banking frauds, sale frauds, and your others. Okay, so I have also given an example under these points. Pause the video, read it, and then move forward. Okay, so I'm waiting for 2 seconds so that you can pause this video. Okay, so I hope all of you have read those internal points. Now, next is your fraud at different levels. So there are three levels. First is fraud for personal gain. For example, your bribery. Second is your corporate fraud, that is Example, advance billing, shell companies, money laundering activity. These are your corporate frauds. And third is your operation fraud. That means which happen in the business itself. So tampering of checks, off-book frauds, cash misappropriation, teaming and lading, fraudulent disbursements, payroll fraud, expense reimbursement schemes, commission schemes. Okay. So all of this come under your operational level. So basically three types. One is personal, second is corporate, and third is your operational level. Procedure for investigation. So a certain duties of person suspected, greater the authority of person. That means with more power, there is a higher chance that this person might do fraud. Wider the area of investigation. Check system of internal controls for spotting weakness and inquire people who have excessive control over the business. So you have to check, you have to ask people who have a lot of control on the business. Since they have a lot of control, it is also easier for them to do fraud. Situations where money may be embezzled. Situations where money may be embezzled. First is your deflating cash payments. Second is your inflating cash payments. So I want you to read your internal points, pause the video, and then I'll move forward. Okay. So that is first is your deflating cash receipts. Second is your inflating cash payments. Okay. Pause the video, learn, read the points, and then we'll move forward. Okay. Then next are your fraud through the supplier ledger, fraud through customer ledger, and your inventory fraud. So basically these are your five. So first what did we did? First we did was your deflating cash receipts. Second was your inflating cash payments. Next is fraud through supplier ledger, fraud through customer ledger, and your inventory fraud. So again, I am pausing the video. I am pausing the video so that you can read these points and then we'll move forward. Okay. I hope everybody has read the points, even points with regards to your verification. Now, what are your indicators of fraud? That means what possible circumstances would you think that there is a fraud? So any partial or incorrect recording, or if there is any misclassification, any conflicting or missing evidence. That means one place you got the evidence which says something else, while the other evidence that you received, that's something else. In such a case, both these evidence are conflicting with each other. It is possible that there is a fraud. Next is denial of access to records or undue time pressure. They are putting you in a rut so that you're not able to check properly. Next, frequent changes in your accounting estimate. So it is possible, since accounting estimate is subjective, it is possible that they will change it so as to prevent their fraud being detected. Okay. And last is your review of profit or financial forecast. So investigations requiring examination of future profits. Okay, so this investigation is with regards to checking whether future profits have been calculated correctly or not. So profit reports can be required as part of investigation into purchase of business, or it could be required by your bank or financial institution with respect to project cash flow and appraisal of your loan application. So before they extend your loan, they want to see that is what will your profits be, because you will be paying your amount, you will be repaying your loan out of profits only. With this we are done. With this we are done with your investigation. So first in this chapter we did due diligence. Now next we did investigation, everything in green. Now everything in yellow is your forensic accounting. Now what you have to remember, earlier this was forensic auditing. Now anywhere where audit was used, you have to replace it with accounting. Okay. So it is now called forensic accounting. So forensic accounting is a dynamic and strategic tool in combating corruption, financial crimes, and frauds through investigation. This is your forensic audit, forensic accounting. Your entire forensic accounting is only related to frauds. Okay. Now what is a red flag? Indicators of warning, caution needs to be exercised while investigating situation. Now you would have understood red flags is when you start dating someone and you see a red flag. So red flags are basically those things which are not good, which you have to dread very carefully. Now, what is the difference between your forensic accounting and your other audits? So first is your objective. That means forensic accounting main objective is whether fraud has taken place, while for others it is to check whether there is true and fair presentation. Next is technique. Your forensic accounting will of course be in depth. However, your other audits will be sample based, because you do not check the entire population. You always select some samples. However, in forensic accounting, since it is based on fraud, there is more in depth, that it is a substantive technique. Next is your period. There is no limitation. However, your other audit may usually be for an accounting period. That means from year ending, say for example, 22 to 23 or 23 to 24. Stock verification provisions, etc. So independent verification of suspected items. So under forensic accounting, you independently verify these. However, under other audit, you rely on the management representation. That means whatever figure the management has given, you rely on those figures for stocks. Next is your off-balance sheet items. Propriety of these transactions are examined, while over here it is used to vouch arithmetical accuracy. And last is your adverse findings. There will be legal impact if there are any adverse findings. That means if we came to find out that there is fraud in your company, there will be legal impact and perpetrators will be identified. However, in case of other audit, it will either be a negative or a qualified opinion, nothing more. You will just give a qualified opinion, rest everything the board will do. Okay. Next is your forensic accountant is involved in. So it is involved in your fraud detection, your computer forensic, your fraud prevention, and fourth is provide expert testimony. Okay. So these are the four areas where your forensic account is involved in. First is your fraud detection. Second is your computer forensic. Third is your fraud prevention. How do you learn this? Fraud detection, fraud prevention. These are two. Then next is your computer forensic. Of course, computers will be required. And fourth is providing expert testimony. Now, forensic accountant is used by whom? So it is used by lawyers, insurance companies, banks, courts, government bodies, and your public forces. Your forensic accountant is used by these parties. Okay. And now this is our last page of the chapter. This so importance of forensic accountant. Importance of forensic accountant is fraud prevention, fraud detection. If you see over here also, these were the same points: fraud prevention and fraud detection. Okay. Next is your risk management, that is your paper 6. Then you have filing requirements, court systems, investigating methodology, and evidence collection and analysis. So these are your importance of forensic account: fraud prevention, fraud detection. Then we did your risk management. Then we did your filing requirements. Then anything related to court, so court systems, investigative methodology, and evidence collection and analysis. This is your importance of your forensic accountant. Please do not write forensic auditor. It is forensic accountant for May 23 and November 23 onwards. Services rendered by forensic accountant. What are the services? First is questions are crafted. Second is responding to questions posed. Third is conducting research relevant to the fact, identifying and preserving key evidence. If you get any key evidence, you have to identify and preserve those. Identify documents to be requested by, plus subpoena. Subpoena means when you have to go through the court to get some documents, it is called subpoena. Next is analyzing produced records and other information for facts. Of course, once you receive the data, you will also analyze this. Identify alternative means to obtain key facts and information. And last is your identify individuals to be most knowledgeable of facts. You have to check which individual will be most knowledgeable, so that it will help you while doing your forensic accounting. Next is areas where services rendered by forensic accountant are in demand. What are the areas? You have your criminal investigation. I have purposely put images so that it is easier for you to remember. So close your eyes, review this once, then close your eyes and try remembering the points. So it is a criminal investigation, professional negligence cases, arbitration cases, fraud investigation and control review, settlement of your insurance claims, and last is your dispute settlement. There are 6 points. Pause the video and try to remember it while you are watching the video itself. Okay, learned? Now, what are the characteristics? Characteristics of a forensic accountant. So, curiosity, persistence. Persistence means he should be consistent. Next is detail oriented. Check details. Inquisitiveness, that means you should have a questioning mind. You should be curious. Next is creativity, and last is your skepticism. Okay. Now all of these words, your skepticism, inquisitiveness, curiosity, all of these words are very similar, but they are given differently. Next are what are the skills? So you should be proficient in information technology, data analytics, criminology, because as we told you, there is criminal investigation also. Then there is legal framework, investigation techniques, and evidence gathering. So all of these skills your accountant should have. Next is process of forensic accounting. So first is your initialization. Second, you will develop the plan. Third is obtain relevant evidence. Fourth is you will perform analysis. Fifth is of course reporting, and sixth is your court proceedings. Because this is related to fraud, it is possible that there will be court proceedings also. So what are the process? First is your initialization. Second is developing the plan. Third is obtain relevant evidence. Fourth is perform analysis. Fifth is reporting, and last is your court proceedings. Great. Now coming to your last part of the chapter, and with this we will be done with the entire audit. So forensic accounting techniques. Forensic accounting techniques is your first of all is your GAT. Then you have another one over here, that is your CAT. Then you have your GAS. Then you have your CST. Then you have your DMT. Okay. So these are all the points. Then you have your TBT and statistical and mathematical techniques. Okay, so this is how I had learned when I was studying audit. When I was studying audit in July 2021. So your general audit techniques, that is your GAT. Then your SMT is your statistical and mathematical techniques. Then your TBT is technology based techniques. CAT is your computer assisted audit techniques. Then you have generalized audit software, that is your GAS. Then you have your CST, that is your common software tool. Then you have your data mining techniques. Data mining techniques is important because there are more category: discovery, predictive modeling, analysis. So I would suggest you to go through the question bank also for this. And last is your laboratory analysis of physical and electronic evidence. Okay. So these are your forensic accounting techniques. You have your GAT, you have your CAT, you have your CST, you have your GAS, you have your DMT, you have your TMT. Okay. So all of these mnemonics you have to learn so that you will be able to write. It is not difficult. Pause the video, learn it right now so that you are done while watching the videos only. Okay, next is your forensic accounting report. So points to be kept in mind: clear thinking, keep the reader uppermost in mind. Okay, so you have to check, you have to see who the reader is. Next is it should be an unbiased approach. Impact of the report should be given. Facts and figures to be in proper sequence. And last is suggestions to prevent fraud in the future. All of these points you have to keep in mind. Great. Next is your main factors for presentation of report. So that is your nature of business, nature of subject or aspect appraised. That means which area you have checked. Next is for whom the report is intended, purpose for which the report is prepared, management attitude, directives and needs, forensic accountant approach and caliber, and last is extent of details required by your auditee. So these are the main factors while presenting a report. And with this we are done with your complete audit. I have uploaded all the videos from A to Z of the entire audit using these 100 pages notes on YouTube itself. I hope for all of those you are watching, you have learned these notes by now. If you want, you can order the soft copy, hard copy as it is. And we also have question banks for all subjects on our website. And with this, we are done with audit, and all the best for your exams.